Well, hello, and welcome to the Financial Perspectives podcast. Today, we're joined by a special guest from one of the world's largest asset managers, Vanguard. Bill Puggini is here with us today. Thanks for joining us.
Thanks for having me.
Bill has been with Vanguard since 2008, had a variety of posts there in research, thought leadership. Currently, in your role, the way I understand it, you're helping clients and advisors with portfolio asset allocation and things like that, kind of portfolio structures.
Yep.
So we're looking forward to tapping your thoughts on how we should be investing or at least thinking about markets this year.
Yeah, absolutely.
So let's start just with a quick look back. We're in January still, at least when we're recording this. So we're close to 2024. Anything particularly surprising for you or for Vanguard last year?
You know, I think the most surprising thing for me is you probably almost have to look back 2 years, but I think 2023 and 2024 had a lot of similarities. And that's that, a lot of us entered those years not necessarily feeling all that confident about the prospects for the economy, prospects for markets. And yet we look back and we saw 25+% returns for both of those years for U.S. stock markets. So I think that was probably the biggest surprise if you talk about like where we started the year and where we ended. I think this year is interesting because I think we're a little bit more optimistic about the economy, but still maybe not so optimistic about the prospects for markets, but a lot to play out.
Yeah, it's hard to remember all the way back to 2022 when inflation was really ramped up. We had the Federal Reserve raising rates and people were like, ooh, how's this going to work out?
Yeah.
I don't know, at that point, we would have thought we were going to put together two of the best years in a row, at least in the U.S. that we've seen in a long time.
Right.
So kind of interesting.
Exactly.
So yeah, let's think about that looking forward. So things have happened. We've had an election, new administration in place. We had the last 2 years. Anything that you guys are particularly paying attention to in 2025 in terms of what might impact markets or investors?
Yeah, there's a lot of things that we're, I think, really keeping an eye on right now. I mean, certainly policy is one. We can talk a little bit about like what elements of that policy could have the biggest impacts. Two, I think, the economy, there's been a lot of, I think, good luck in the economy, as well as, the Fed is ultimately trying to engineer with a quote unquote soft landing. In some ways they've been good and other ways they've been lucky, which is a good thing for all of us.
Either way, yeah.
But, a lot of the things that we're continuing to keep an eye on is things we've been looking at the last couple of years. We still have very high equity valuations. That gives us pause for U.S. equities. But at the flip side, it's kind of like the opposite of what we've seen, right? We've seen really strong equity markets that's left us with high valuations. We've seen difficult fixed income markets because of the effects of rising rates. But now we have those higher rates. We have higher yields. So the prospects looking forward look a lot better there. So those are some of the things that we're keeping a look on. I'd say our prospects for the U.S. economy is a little bit more status quo than it has been. A little bit of maybe a boring outlook because we're not expecting things to be phenomenal. We're not expecting things to be terrible. So I think keeping a little bit closer look on the financial markets, but then also trying to figure out what. There's been a lot of things stated on the policy side, but I always say there's three things. You have the stated policy, the real policy, and then the actual policy that gets implemented. So a lot of uncertainty there that we'll be keeping an eye on as well.
Yeah, we've heard a lot. I mean, these first days of the new administration, we've obviously been a lot of talk coming into it about tariffs, for example. What's really going to happen? There's already been a little bit of a backing off of timing, at least on what's going to be there, or some conditionality to those. Like, well, if you do this, maybe we won't do it.
Right.
Certainly the tax law is kind of, I think everybody expects now that the existing tax regime will be extended, but will there be any other changes to that? That certainly could have an impact on things. This idea of a soft landing is really, I'm kind of puzzled by that one. The more that we say soft landing, it's like, I think, will there ever actually be a landing? What does it look like to hit the ground? Because it feels like we've been talking about a soft landing. I think about a plane coming into a runway. It's kind of like, well, it's been this far above the runway for how long? Because it feels like we've kind of gotten this thing down, at least, like you said, the economy should be relatively status quo, which feels like, well, have we landed it? The Federal Reserve is always going to move interest rates a little bit, it seems like, because there's some fine tuning that they'll do. But it doesn't feel like there's a lot left, at least in their mind, in terms of, hey, we don't have a ton of ground left to cover.
Right. Yeah. I mean, there's always these buzzwords, right? And there's always like semantics. Like, what does this actually mean? Where are we actually? I think from our view, even more important than using necessarily even the terminology of soft landing, that's more just the buzzword that's been out there. But I think for us, what we're seeing for the end of the year is inflation that is at least under control, if not all the way down to target, and an economy that continues to expand. And that's what we see. I think that's somewhat of a boring outlook, but yeah, I mean, you have inflation now. There's all these different measures of inflation, which not everybody talks about, but the primary number that the Fed looks at is below 2.5%. Their target is 2%. The headline number that a lot of us see is probably closer to 3%. So we can get into some of those differences, but there's just a lot of nuance there to how you measure inflation, what you're actually measuring. And the one that the Fed tends to find the most important is also the closest to their target. So from that standpoint, we think we're closer to a point where the Fed isn't going to significantly lower rates. Probably isn't going to, probably are not going to raise rates. So at a point where we're closer to that long-term equilibrium, if you will, is kind of how we're thinking about it. Even though, to your point, the quote unquote, the term landing, like maybe we're not actually at something that is a landing, maybe more of a long-term hover.
Well, I kind of hope they don't have to lower. I mean, as savers or people who might own bonds, you'd think, boy, it'd be nice if we could have economic growth at this level of interest rates, because then investors in a diversified portfolio could have the benefits of economic growth, growing companies, hopefully would be good stock market returns, as well as having a portion of their portfolio and the bonds portfolio that actually has got some nice yield, which was certainly not the case for years when interest rates were near zero. That was pretty tough. You're holding those bonds to dampen the volatility still, but at the same time, you weren't getting paid a lot to hold that.
Yeah, I mean, the hard thing with bonds, right, and there's an inverse relationship, right? When interest rates go up, you now have higher interest. You're getting more yield in return going forward. But when interest rates go up, prices go down. So, and in 2022, we really saw the perfect storm for that, right? We basically had zero rates, and we went from 0 to 5%. So that causes a lot of price destruction. At the same time, because rates were almost zero, you're getting no yield in return to offset that. And as a result, there's a lot of scar tissue built up, a lot of fear of investing in bonds and interest rate risk. But we think we're at a much better spot now. So we're very different. I mean, now you have 4%. So you actually saw interest rates go up over the course of 2024. Yet we still had positive returns for bonds because you are receiving yield that's offsetting some of that price difference. And so we think that that's a relationship that is significantly more healthy for both the economy as well as investors, is you have that higher yield to offset any potential difficulties with price. So we feel just significantly better about bonds going forward from here.
I think we would agree with that too. So we've talked a little bit about the U.S. Let's kind of shift focus for a minute to international markets, particularly international stocks. I know Vanguard has always been a big believer in a degree of international diversification. We are the same. When I looked at kind of your 10-year forward look recently, the thing that struck me was very positive on the next 10 years for stocks outside of the U.S. A little so positive it made, and less positive at least for U.S. stocks. I think the thing I looked at was the low end of your outlook for foreign stocks was higher than the high end of the 10-year outlook for U.S. stocks. That's quite a thing. So let's talk for a minute about, because that certainly hasn't been the case in the last few years in terms of international stocks doing well. What's the optimistic case for foreign stocks?
Yeah. Look, I think the big thing we're talking about here is the next decade is probably going to look a lot different from the last decade. This last decade, I think, has been marked by phenomenal U.S. equity returns. But as a result, that kind of gets things out of balance a little bit. And that's how we think about this shift over the next decade and what they're going to look at. there's really four components of how we think about return going forward in stock markets and for international. You have valuations. So what's the price that you're paying? The price matters. Two, what's the underlying growth that you're getting from the companies that you own? So earnings growth. Number three is what are you getting in return for that? That would be dividends. And then the fourth one for international is what happens with the dollar. So if the dollar is strong, then U.S. investors in international equities, that's actually a bad thing. If the dollar weakens, then those foreign investments are worth more. So as we look back over the last decade, if you think about those four things, we've seen greater price appreciation in the U.S., in isolation of just, the U.S. has outgrown international, so certainly, but the price, in isolation of that growth has been higher in the U.S. Yeah. The growth has been higher in the U.S., and the dollar has strengthened. So 3 out of those 4 things have been very strong for U.S. investors. Looking forward over the next decade, we do think the U.S. is a more growth-oriented economy. So we do think that the U.S. will continue to outgrow international markets, but prices are a lot higher. So we expect the prices to not continue to appreciate as much for U.S. stocks. Dividends now, as a result, are about double in international markets than they are for the U.S. And while we think there are some near-term tailwinds for the dollar to strengthen, we ultimately think over the next decade the dollar is likely to weaken. So, you have an essence of looking back. 3 of the 4 things I mentioned were in favor for U.S., but looking forward, we see 3 of those 4 playing out more favorably for international, and that's why. The difference in outlook, like you mentioned.
Yeah, I think I saw a chart the other day. It just showed for U.S. stocks, the earnings growth has been very good, but the multiple or the expansion that people are willing to pay for that growth has really gone up. So if you think about what you're paying for $1 of earnings, this idea that, wow, we're willing to pay way more for that same dollar of earnings in a U.S. company right now than we are in a foreign company. And it's an interesting thing. I think price is one of those areas where investor sentiment can really run for a long time without paying a ton of attention to the actual, metric, the valuation measure. It's like, well, if people think it's going to continue to grow and it's grown to the point, why do I not? So at some point, though, you think, okay, price will matter at some point. Is there any sense, maybe historically, where a tipping point is reached where all of a sudden price, or maybe an example in history where a tipping point has been reached and all of a sudden price now matters and you just start to see that adjustment?
Yeah, it's an interesting question, right? We have very high valuations right now. That's one of our concerns or biggest risks in the U.S. equity market.
And just when you say valuations, you're talking about things like the price to earnings ratio.
Exactly.
Something like that. Yeah.
Exactly. Yeah. So how much are you actually getting from those stocks? How much are they earning? Yeah. And what are you actually paying for that earnings?
Yeah.
I'll maybe take one quick side tangent. I think it's related to the question, but things can be illogical for some time. And there's a lot of sentiment. Like what do people think is going to happen over the next decade versus what actually does happen with earnings and things like that. We were talking to one of our portfolio managers the other day, and a company that they were talking about really liking is Unilever in the UK. They were comparing it to Procter & Gamble here in the US. Very, pretty similar businesses, just one in US, one outside of the US. Yeah. They actually like the prospects of Unilever better than the prospects of Procter & Gamble, just from an outright standpoint. But also, Procter & Gamble is priced at 22 times earnings, whereas Unilever is only priced at 17 times earnings.
Yeah.
So you have a company that you may like better, on a forward-looking basis on an absolute standpoint, and it's trading a lot cheaper just because it's not in the U.S. Yeah. So that's some of the illogical things that we're kind of seeing between the U.S. and international markets when I'm talking about, the price that you pay matters. But two, often you don't see poor returns just because valuations are higher. Usually you see a correction because something happens.
Yes.
I don't want to scare people, but the closest parallel we have to the market today is the dot-com bubble. There's a lot of differences, right? The companies at the top of the U.S. now are the fastest growing. They are the most cash generative businesses, the highest quality. Yeah. So that is a big difference from the dot-com bubble. At the same time, that's probably a period of time that we could look at and say, like, what actually happened? And really what happened is you had large areas of the market that were being priced very favorably and, projecting out these phenomenal earnings just on the back of the internet. Yeah. Right. And I think ultimately what you had back then was all of a sudden a failure for the earnings of those companies to live up to those valuations. Yeah. And eventually the market got smart on that and they started realizing you have to reprice these things because expectations are changing. Yeah. So that's, I think, a big part of what could happen. I mean, as of this recording, yesterday there was a big news that came out about a Chinese AI model. Yeah. The concern there is, hey, we're pricing in basically perfection for a lot of these mega cap companies, these big successful companies in the US. And what happens if all of a sudden we think, some of this artificial intelligence developments can be done with significantly less input, less cost, and less hardware components. All of a sudden, maybe you don't need all the chips that you thought. So, right, that caused a huge correction with companies like NVIDIA. And, we don't know where that's going to shake out over time, but I think it just points out the risks that, hey, we're pricing in perfection now. And if you see even some small cracks in some of those expectations, it can cause really big corrections. So those are things that we're keeping an eye on.
Yeah, I was I was in the investment business in the dot-com period. And I think the thing that strikes me now is these large companies that are, they are priced expensively, not nearly as expensively as what was happening in the dot-com bubble. And so many of those dot-coms at the time, they didn't even have positive earnings. They had revenues, but everybody got so excited about revenues, but nobody was actually making any profit. The big companies today, they are profitable. I mean, hugely profitable in terms of the amount of money that they're making. So, as is always the case, things are not exactly the same as they were, but the idea that there's a part of the market that appears to be fairly expensive relative to another part of the market, you would think, at some point, if that less expensive part of the market continues to do well, let's say they have some, they continue to produce positive earnings, people say, well, why am I paying so much for earnings over here when I can get good earnings over here? And will these companies that have seen such dramatic growth, can they continue to grow as fast in the future? We'll see. I mean, that's a little bit of a game, which we like to think, let's just own the entire market as opposed to trying to think, hey, this one part is going to be the answer for the long term.
Right. Yeah. I mean, I think I think that's really the case for a diversified portfolio, right? It's built to be all weather. There's a great quote from our founder, Jack Bogle. He said, I made a career out of knowing what I don't know. And I think a lot of us lose sight of that sometimes. We don't know what the future holds. We don't know what's going to happen tomorrow, 6 months, 12 months, 10 years out. Ultimately, we're trying to predict the future in some sense. And so even us having a very low outlook for U.S. equities doesn't mean we're not going to hold equities because we don't know what we don't know. We don't know what's ultimately going to happen. Really, it's just a case for holding a diversified portfolio so that you can have segments of that investment portfolio that are going to do really well no matter what happens. And it holds you better for different scenarios that could come up.
Yeah. We have 5 big investing principles at Foster Group. Number 2 is embrace uncertainty. Just for that reason. We feel like it's very hard to predict the future. So you want to prepare for a variety of possible outcomes. And the way you do that is this diversified portfolio, both within your stock portfolio itself, but also the other kinds of assets that you hold, which is really nice now, again, to have some positive yields in bonds, for example, to feel like, well, this is now, again, a part of the portfolio we can feel good about because you're seeing good income come off it, which is nice.
Yeah, I think the huge thing in fixed income, I mean, for bonds, not only were rates really low, you were actually seeing yields, the income that investors were getting was lower than inflation. Yeah. So in other words, negative real returns. Now, I think kind of what you're hitting on there is you have income and yield that is above inflation, so positive real returns. We haven't seen that from that part of the investment portfolio for a long time, which is why we like it.
Yeah, it is great. So let's kind of turn and ask you a couple questions about Vanguard since you're here.
Sure.
What are some of the new things or interesting things that Vanguard might be working on?
Yeah, I think so. We had a new CEO come on in July, and I really think that what I would summarize what we're looking to accomplish as a business. I think we're all in on that fixed income side. We're seeing a lot of investment in our fixed income capabilities. We have really talented managers there, and not as many assets as we have on the equity side. And so, we think we can provide a lot of what we've done for investors on the equity side, which has primarily been to bring costs down. We think we can do a lot of that on the fixed income side. And so it's an area where we really feel constructive about, both from an investment return standpoint, but also the capabilities that we've really invested in over the last decade as a firm on that fixed income side, and starting to see the fruits of that and bringing those benefits to investors as hopefully other firms start to increase that competition, also start to bring costs down, which we like to coin as the Vanguard effect to the market. And so hopefully we'll start to see some of that broaden out to areas outside of equities.
Yeah, well, we've appreciated that. We've watched, in our portfolios that we manage, there are significant parts of them that we use Vanguard investment products. And part of the reason is the cost is so compelling. I think another thing your founder, Jack Bogle, talked about a lot was, one thing you can control is expenses. And if you can keep the expenses low, those are things to pay attention to. One of his quotes was something like, the two biggest enemies of the investor are expenses and emotions. This idea of, hey, you got to keep yourself in control and watch out for expenses, because those things can just eat you up.
Yeah, it's a good one. He's got a lot of good sound bites.
He's got a lot of good sound bites, yeah. Okay, so you've worked with investors, internally, externally for years. What have you seen as like some of the biggest, let's say, misunderstandings or maybe missteps that investors make?
Yeah, I think you hit on a big one, which is expenses and emotions. I'll throw another quote out there, not from Jack Bogle, but from one of our internal portfolio managers, that the market puts a tremendous amount of pressure today to do what you should have done yesterday. In other words, you see something do really well, and then all of a sudden you pile into that. So it gets to the emotion side. Or you see something go down, and all of a sudden you sell it. When a lot of times you should be doing the opposite behavior. I think that's a big role of the advisor, quite frankly, is to help manage some of those emotions. But a lot of times that's why investors aren't successful, is because they react on those emotions. They buy into the things that are doing really well, or they sell out of the things that are doing really poorly, and then things reverse course. So I think having not only the emotions and the expense under control, but having incredible discipline. That's why we create investing and financial plans, and really create these like rules and framework to stick to that, because of the sense that the uncertainty in the investment market. You don't know what's going to happen tomorrow. So how do I set up a framework today that's going to help me avoid the emotional pitfalls that I might be subject to tomorrow, and really sticking to that. I think that's it's a simple recipe, but it's one that we are all challenged with, on a daily basis, given the results of what happens in the market on a daily basis.
Yeah, it's an interesting formula. You're speaking our language there. It is a fairly simple thing to understand, but yet investing is hard, because to just execute on that day after day after day, year after year after year, it can be hard to kind of stay in your seat. I think another quote by Bogle was, I think he said something like, don't just move, stand there. But the idea of, hey, oftentimes the best thing to do is to stay in the portfolio structure that you set up, because that thing was set up based on a long-term financial plan. Markets are going to go through cycles, and this thing is set up to kind of be that long-term picture. But it is hard when we are bombarded with day-to-day information that makes it feel like, maybe I should be changing something here because of something that might happen tomorrow. Right. Or, like you just said, something that just happened yesterday, as though that's going to be really determinative long-term in the portfolio.
Exactly. Yeah, I think that plays into our outlook too. I mean, I think over the last decade, U.S. equities did phenomenally well, and investors were really better off for it. But it's easy to look back and say, like, why did I hold anything else?
Yeah, right.
And that's really the concern is, looking forward for the next decade, given our outlook is very different. We think everything else, if you will, of the portfolio is going to play a much more important role. And so, keeping an eye on why you hold those things, even though they might have, quote unquote, held you back over the last decade, we didn't know exactly what that decade was going to look like at the start.
Yes.
Just like we don't today. And so, continuing to hold all those things, I think plays a big role. And what am I talking about? Those other things? It's mostly fixed income and it's international equities.
Yeah. Well, we appreciate you spending some time with us today. I think about that last little bit. One of my favorite sayings is, hey, you must be present to win. Mm-hmm. And we don't always know what's going to perform best next. But if you're present with all those things that could perform well, then the possibility of winning exists. I think with international and fixed income, it's a great example of if you're not holding it when it takes off, you'll likely be too late. It'll go. Generally, things turn and they turn fairly quickly.
Yeah. Yeah. And the last thing I would say too is, you don't need those things when U.S. equities are doing really well. You need them when they're doing poorly.
Yeah.
And U.S. equities have done really well over the last decade. But if they don't do so well, you need those other things.
Yeah. Well, thanks for joining us today, Bill. We appreciate all the work that Vanguard's been doing throughout the years for investors. Certainly the research, the lowering of costs, as you see the Vanguard effect across the world. And those are benefits to investors, and we appreciate that work. Bogle said some great things. I will say this one again, don't do something, just stand there. He encouraged this kind of long-term investment mindset versus speculation. That's really something that we believe strongly in. There's a lot of things that are creating speculation in the market today. Certainly we see that with cryptocurrencies or just gambling in general. There's a lot of things going on. And our hope here at Foster Group is to encourage more of a long-term, educated, optimistic outlook in terms of how you think about investing. There is a lot of stuff going on in the world today that would try to paint a very pessimistic picture, maybe some fear mongering, some skepticism. When really the picture, I think, for investors is generally bright, and we can bring facts to bear on that, especially for people who think long term. And that's what we want to do here at Financial Perspectives, is just encourage you to think about how to become an educated optimist, because we think educated optimists have a great antidote for kind of fighting back fear and anxiety. If you'd like to contact Financial Perspectives, you can come find us on our website at www.fostergrp.com. Just click on Financial Perspectives and you can send us a message or comment on this. We'd love to hear from you. So until next time, Bill, thanks so much for being here today. And audience, thank you for watching. We'll see you soon.